What if I told you that right now, millions of retired Americans are making a single banking mistake that could trigger a $10,000 penalty from the IRS, and most of them have absolutely no idea they are doing anything wrong? This is not a hypothetical situation. This is happening to real retirees across the United States every single day, and the number of cases is growing rapidly as the IRS ramps up its enforcement efforts in 2026. Stay with me until the very end of this video because what you are about to learn could save you from one of the most financially devastating surprises of your retirement years. Welcome to SSA Benefits Alert, the channel committed to protecting the financial lives of American retirees and seniors by delivering clear, accurate, and timely information about Social Security, Medicare, IRS rules, and everything else that affects your money in retirement. Today we are talking about a banking mistake so common, so easy to make, and so poorly understood that even financially savvy retirees are falling into the trap. We are going to explain exactly what this mistake is, why it triggers IRS penalties, how the penalty works, who is most at risk, and most importantly, what you need to do right now to protect yourself. Let us start by setting the stage. When most Americans retire, they shift from a relatively straightforward financial life where taxes are withheld automatically from a paycheck to a much more complex situation where income comes from multiple sources. You might be drawing Social Security benefits, taking withdrawals from a traditional IRA or 401k, receiving pension payments, collecting interest or dividends from investments, and perhaps even earning some income from part-time work or rental property. Each of these income streams has its own tax rules, its own reporting requirements, and its own interaction with the others. Managing all of this correctly requires a level of financial literacy that most Americans were never taught and that most financial advisors do not explain clearly enough. The specific banking mistake we are talking about today involves required minimum distributions, commonly known as RMDs. If you have money in a traditional IRA, a 401k, a 403b, or most other tax-deferred retirement accounts, the IRS requires you to start taking a minimum amount of money out of those accounts every year once you reach a certain age. Under the current rules following the Secure 2.0 Act, that age is 73 for most Americans, though it will increase to 75 for those born in 1960 or later. The amount you must withdraw is calculated based on the balance in your account and your life expectancy according to IRS tables. Here is where the banking mistake comes in, and it is a mistake that takes several different forms. The first and most common form is simply failing to take the RMD at all. This sounds obvious, but it happens far more often than you might think. Many retirees, particularly those who are financially comfortable and do not need to draw down their retirement accounts for living expenses, simply forget that the IRS requires them to take these distributions whether they need the money or not. Others know about RMDs in theory, but do not realize they have already reached the age at which they must begin. And others rely on their bank or financial institution to remind them, not realizing that while many institutions do send reminders, they are not legally obligated to do so, and the ultimate responsibility rests entirely with you. The second form of this mistake involves taking the wrong amount. The RMD calculation is not simple. It requires knowing the exact balance of every qualifying account as of December 31st of the previous year, and then dividing that balance by the appropriate life expectancy factor from the IRS Uniform Lifetime Table. If you have multiple retirement accounts across different financial institutions, you need to calculate the RMD for each account separately. While you can take the total RMD amount from just one IRA if you have multiple IRAs, the rules are different for 401k accounts, where you must take the RMD from each account individually. Getting this calculation wrong, even by a small amount, means you have not satisfied your RMD requirement, and the penalty applies to the shortfall. The third form of the mistake involves timing. The IRS has specific deadlines for RMD withdrawals. For most retirees, the deadline is December 31st of each year. However, for the very first year in which you are required to take an RMD, you have the option of delaying until April 1st of the following year. This sounds like a helpful flexibility, but it creates a trap that catches many first-time RMD takers completely off guard. If you delay your first RMD to April 1st of the year after you turn 73, you will then also owe your second year RMD by December 31st of that same year. That means 2 full RMDs in a single calendar year, which can push you into a higher tax bracket and create a much larger tax bill than you anticipated. Many retirees make this timing decision without fully understanding its tax consequences, and their bank account ends up looking fine on paper while their tax situation has become significantly more complicated. Now let us talk about the penalty itself, because this is where that $10,000 figure comes from, and it is important to understand exactly how it works. The IRS penalty for failing to take a required minimum distribution is currently 25% of the amount that should have been withdrawn, but was not. Under the Secure 2.0 Act, this penalty was actually reduced from the previous rate of 50%, which was one of the harshest penalties in the entire tax code. Even at 25%, however, the numbers can add up very quickly for retirees with substantial retirement account balances. Consider this example. If you have a traditional IRA with a balance of $300,000 and your RMD for the year is calculated at approximately $12,000 and you fail to take that distribution, the penalty is 25% of $12,000, which equals $3,000. That is $3,000 owed to the IRS on top of the income tax you would have paid on the distribution anyway. For retirees with larger account balances, the numbers escalate rapidly. An IRA balance of $600,000 might generate an RMD of around $24,000, and a 25% penalty on that amount would be $6,000. Add in the income tax on the full distribution when you eventually do take it, and the total financial damage can easily reach or exceed $10,000. There is also a cascading effect that many retirees do not anticipate. When the IRS identifies an RMD failure, they do not just assess the penalty for the year in question. They also review previous years to determine whether the same mistake was made in the past. If you have been failing to take your RMD for several years, the penalties can stack up dramatically, and you may also face interest charges on the unpaid penalties going back to the year each missed distribution should have occurred. The good news is that the IRS does have a waiver process for RMD penalties. If you missed an RMD due to a reasonable error and you can demonstrate that you are taking steps to correct the situation, the IRS may waive the penalty. However, obtaining this waiver requires filing specific paperwork, demonstrating reasonable cause, and taking the missed distribution as soon as possible. It is a process that requires attention to detail, and in most cases, the help of a qualified tax professional. It is far better to take your RMD correctly in the first place than to rely on the waiver process after the fact. So what should you do right now to make sure you are protected? The first step is to determine whether you are currently required to take RMDs. If you are 73 or older and have money in a traditional IRA, 401k, 403b, or similar tax-deferred account, the answer is almost certainly yes. If you are younger than 73, mark the date when you will reach that age on your calendar and start planning now. The second step is to contact every financial institution where you hold retirement accounts and ask them directly whether your RMD has been calculated for the current year and whether you have already taken the required amount. Many financial institutions offer automatic RMD services where they calculate the amount and distribute it to you automatically each year. If your institution offers this service and you have not already enrolled in it, do so immediately. The third step is to speak with a qualified tax professional or financial advisor who has specific expertise in retirement account distribution rules. This is not a situation where general financial advice is sufficient. You need someone who understands the specific rules around RMDs, the interaction between different types of retirement accounts, and the tax implications of different distribution strategies. The fourth step is to review your withholding. When you take your RMD, federal income tax is not automatically withheld unless you specifically request it or your financial institution withholds by default. If you take a large distribution without adequate withholding or estimated tax payments, you could face underpayment penalties at tax time on top of any RMD-related issues. American retirees have worked an entire lifetime to build the savings they are now living on. The last thing anyone needs is to hand thousands of dollars to the IRS in unnecessary penalties because of a banking mistake that was completely avoidable with the right information. That is a wrap on today's video, and it has been one of our most important yet. If you found this information valuable, please give this video a thumbs up and share it with every retiree and near retiree you know. Subscribe to SSA Benefits Alert and hit the notification bell so you never miss critical information that protects your retirement income. Drop a comment below telling us whether you were aware of the RMD rules before watching today. We read every single comment. Until next time, stay informed, stay protected, and enjoy the retirement you worked so hard to earn.